Welcome to the HomePad podcast. This is Raphael, and today we're going to talk about creative financing, how to afford your dream home today. So, a lot of times you may have some credit challenges or blemishes or income reporting restrictions, and a lot of that really holds people back from being able to buy a home because they think that they can walk into their institutional bank and just apply for a mortgage and they're not going to touch them with the 10-foot pole because a lot of times they don't have perfect credit or the perfect financials. And I see this time and time again. But this is one of the reasons why I love being part of the broker community, is because we're like, wholesale, kind of like Costco, where we have different brands, different banks, different lenders, different products. That's what they usually call them. It's like a product, but those services or products, they have different guidelines. So a lot of times they're lending their own money, so they make up their own rules. Sure, do they still have to abide by a lot of the federal laws, but a lot of times they can make exceptions based on compensating factors. And if you've listened to my podcast over the last couple episodes, and if not, go back to them, I've talked about in depth what compensating factors are. And to save you a little bit of time, it's just going over if you have some blemishes, what are something else that is positive that you can show that is what we call a compensating factor. So a lot of these lenders will have different rules, and all they're trying to do is what's called your ability to repay. That's it. They don't really care about a lot of the stuff that you think matters to them. It all comes down, will you show numbers in your ability to repay? And when you take a look at it, a lot of their lending makes sense because there's a lot of different products out there. And it's not just for first-time home buyers or conventional buyers. There's a lot of loans and clients that we help who are business owners. And these business owners bring in a lot of money through their bank account, but they don't claim all of it as profit in their taxes. They claim every deduction under the sun, all the vehicles they bought, the retail store, their employees, payroll. I mean, there's so much in there that they could say, hey, yeah, we're $1 million company, but we only report $96,000 a year in gross profit. So what the bank will look at is you're not making $1 million, you're making $96,000 because that's what you claim on your taxes as profit. So a lot of the times I talk to a lot of business owners and they'll tell me what they make, and I'll just ask them, let me see the K1. So for those of you that don't know, K1 is one sheet of paper inside your business taxes, especially for S corporations. And the K1 will tell me what did you net. For LLC companies, it's just their Schedule C profit and loss, and then we see what that final number is. So yes, in the front sheet it'll say, $1 million, but we really want the K1, and the K1's going to let us know how much you're actually reporting. And a lot of the times they get their hopes up, but when we look at the K1, we find out that there's not a whole lot of money reported on there, and then they feel like they don't qualify. But because there are different options, some of the lenders do realize that there's literally $1 million flowing in through that business bank account, and not all of it is used. A lot of it is just inflated deductions, as rightly so. They're using the tax code. Let's just say they bought a vehicle over 6,000 pounds, and they got a deduction for 100,000 or what. There's just different things that business owners do to get write-offs. And a lot of what we can do is take a look at what is your average daily or what is your average monthly deposit into your business bank account. And then what they'll do is take 12 months of business bank statements and then add them up. So we get a big number, and then we divide it by 12. Why do we do that? Well, every business, and if you are a business owner, you know that sometimes business is slow. Businesses sometimes pick up. Sometimes you have a slow season. So you're not always going to be depositing the same amount like a regular, person that works 40 hours a week and deposits the same amount. Sometimes, I see business owners that will deposit $100,000 and then the next month it'll be like 15. So what happens is that they're trying to get an average of your monthly deposits. So that's why they have to add it all up and then divide it by 12, and that'll give you an average of how much you technically deposit. So let's just round up right now. If your average deposit is, let's say, $10,000, then what we look at is we instantly take a 50% expense ratio, which means that technically we say that your take home is around $5,000 a month. So right away, whatever that number is, and I'm just making up numbers here. Let's say it's $10,000. Automatically, we're going to say that $5,000 is available, and that's like a 50% expense ratio, and that'll be like the income that you bring in. So that's how we calculate, a different way for you as a business owner, how you can qualify for a home. But what I love about this is that we can have a lot of creative financing, which a lot of people don't know that these programs exist. There's a lot of programs with really light documents in order to get you approved. Sometimes, good credit and a really big down payment can solve a lot of those issues for you because they're looking more at the ability to repay. So a lot of times when they look at the compensating factors is they're looking at a credit score and how much are you putting down, and then what other features or what other ways do you show you can make the monthly payment. So sometimes it's how much you deposit in your bank account. Sometimes, they look at other factors of how you bring income. And a lot of times it's not always traditional lending. Yet 99% of those loans are still 30-year fixed. So a lot of times, most people, especially if they bought a home in 2008, 2009, they don't want a variable interest rate because they get scared that the payment can go up. But a lot of times those loans don't exist anymore. Everything is just a 30-year fixed loan. And that's really nice for you because it allows you to get into a home. And, the other alternative is you would have to report all of that income to the IRS, and then you would have to show all that money. So a lot of the banks or institutions that work on bank statement loans, it's very helpful for business owners because they can still buy a home and be able to claim their deductions, but they'll be able to do it under different terms. Now, you have to understand too that because you're doing this, there is a bigger risk to the bank because they're not looking at your taxes to pre-qualify you. So number one, the interest rates are automatically going to be slightly higher. But guess what? There's nowhere else that you would be able to get a traditional loan without it anyway. The rates is not too much. It could be a point or half a point or just give or take depending on how much you put down. And to get a better interest rate that's more similar to what the current rates are now, I would suggest putting down 20%. And 20% gets you to a closer rate. You have programs available that you can put down 15%, and then the interest rate goes up. And then I have different lenders that can go as low as 10% down on a bank statement loan, but then those interest rates are a little bit higher. So you can't have your cake and eat it too. I see that's like the number one thing that I see just with business owners. They want the pretty little interest rate with a little bow on top, but they don't report all their profit on their taxes. And you got to do one or the other. You got to go and report all of the money to the IRS, and then based on that, you may get a traditional loan depending on how much you're reporting. And I do have a lot of businesses that do really well into the millions, and they report everything, and because of that, they get to leverage those conventional loans. And then I have other type of business owners, contractors, roofers, you name it. And they just like to write off more things. And, one of the things that they'll have to do is put down, 20%. But on the upside, that 20% is not a fee. That 20% goes straight to the balance of the home. So automatically their balance is going to be low. So their payment is just only based on the remaining balance, which also lowers their payment. So there's a lot of upside to that. So when it comes to creative financing, there's a lot of benefits to this, but you get to explore what is available for you. Because you can also say, you know what, let's go find a home with a seller who would help me with closing costs because I'm putting so much money down. And it's really good to just look at all of your options and not just look at everything by just saying, you know, they didn't approve me because of my credit score or, you know, how I report my income. Creative financing has everything to do with what is your current scenario, and is there a workaround, or is there a program, or is there a guideline that could help you get into a home. So hopefully that helped you out, especially if you're a business owner. I love creative financing. We do this every single day. And I know that a lot of times it works really well for them. Sometimes we have to guide them to, you know, take a different direction or save more money or do something else or start making deposits. One of the things that I will tell you right now, if you just have mattress money, or if you just get a lot of cash and you don't deposit, there's really nothing that I can show to a bank without you physically depositing money. So if your intention is to get a bank statement loan and you're not depositing into your business bank account, that's something that I would suggest for you to start looking into, because without it, there is no documentation to show how much you deposit on a monthly basis to your bank account. But once you get past that, I would say that, you know, that's probably one of the stepping stones for you to start with creating financing, is starting to show somewhere where you're depositing the money. So that's all I got for you today, and I'll see you on the next episode.